What is up, YouTube? In today's video, I'm going to be talking about Disney's Q2 2020 earnings reports, which was reported after the bell on Tuesday. The stock jumped around on the news of the report, but was down more than 2% after hours on the earnings call. So the coronavirus has affected certain aspects of the business, including theme parks and cruise businesses. The services have been going up, especially their new streaming service, Disney Plus. So now let's talk about what Disney exactly reported. So earnings per share were 60 cents and revenue was $18.01 billion compared to the expected 89 cents by Wall Street and the revenue of $17.80 billion. So revenue was a beat as Wall Street expected $17.80 billion, but earnings per share was off. Wall Street has been anticipating earnings per share of 89 cents, so it was 30% off the expected amount. Now let's compare to Q1 of 2020, where earnings per share were $1.53 and revenue was $20.86 billion. So we see the difference in revenue and earnings because of the cruises and theme parks as they've been shut down amid this pandemic. Now let's compare it to last year's Q2 2019 earnings reports. So earnings per share were $1.61, while revenue was $14.92 billion. So you can see why revenue grew a lot, and that is because Disney Plus, and it has been about 6 months since it's actually been open. But earnings per share is way off, as 80 cents is 50% of $1.61, and that is obviously because during this time, there were a lot of movies, plus theme parks and cruise lines were open. Now let's talk about how the revenue was actually distributed. So parks, experiences, and consumer products were about $5 billion. Media networks were about another $7 billion. Studio entertainment was $2 billion, and direct-to-consumer was around $4 or $5 billion. So let's talk about what those actually were. So media networks include ABC, Disney, Freeform, and ESPN. This contributed, as said before, of around $7 billion. Parks, experiences, and consumer products obviously are Disneyland, Walt Disney World, cruise lines, and wherever else you go that's Disney, like Disneyland Hong Kong, Disney Store, Adventures in Disney, etc. And this attributed to around $5 billion in revenue. And studio entertainment includes Pixar, Lucasfilm, Marvel Studios, the Walt Disney Studios, a Disney Music Group, which attributed to around $2 billion of revenue. And this is because most productions of movies and TV shows have been stalled amid this pandemic, which have definitely slowed down sales, and most of their big movies have been postponed to about a year. So don't expect this aspect of the business to grow very fast after the coronavirus pandemic. It should be about 3 months for it to recover. And the last business which has been growing at a really fast rate is a direct-to-consumer, which attributed to around $5 billion. And this includes Disney Plus, Hulu, ESPN Plus, and this has been doing really well. It's the revenue and the amount of subscribers they've gained is insane. So now let's compare Disney streaming subscribers and Netflix. So under Disney comes Disney Plus, Hulu, and ESPN Plus, which has been discussed previously. So currently there are 54.5 million subscribers for Disney Plus, which is exceptional considering it's only been open for less than a year. And Hulu has now 32.1 million subscribers, and it has risen 27% year over year. And ESPN Plus has around 7.9 million subscribers, and I don't think it'll grow anytime soon, considering the fact that sports and other events won't really happen until December. Those are the talks that are coming, especially from the NBA. They're saying they'll start operations again in December. Now, what does this mean for investors? Well, I'm actually surprised that it's actually done this well. And cruise and theme parks have actually reported pretty good revenues, considering the fact of what situation we're in. But I think Q3 will be a lot worse for theme parks and cruise lines because all their operations will be closed for all 3 months. While Q2 is only closed for 1.5 months. But I do think the streaming services will do a lot better, and I don't think we should go into panic mode just yet, and I won't sell or buy right now unless it goes back down to $80 or $90. I'll slowly start buying, but as of now I won't sell. And mind this was a $140 stock a couple months ago, So it's down quite a lot from its all-time highs. And yeah, and even if we compare Netflix and Disney, Netflix is like the giant of this industry, and Disney's halfway there within a couple of months. So if we give it a couple more years, I do think eventually it will reach Netflix's position, or maybe 80 or 75% Netflix position. And if we compare them, then Disney will grow a lot more, because Disney is not just a streaming service, but it's also, they also have theme parks, they also have movies. And I know Netflix do produce their own movies, but they make money off the subscriptions. But some of Disney's movies also go in theaters, which produce huge revenues. For example, you could take Avengers Endgame, which is the movie with the most revenue in history. Infinity War also had great revenue. And also Disney's planning to produce more of their shows, which I do think will be great for growth of Disney Plus. But all those will be shut down at the moment because of the COVID-19. But after this situation passes by, I do think Disney is a great growth safety stock. They also pay dividends, but dividends will be stopped for 6 months. But I do think after that they'll pay it. I don't think they'll pay like the amount they pay right now right away. I think slowly they'll pay it back to the percent they're paying now, and they'll slowly start to increase it again. So if you guys enjoyed this video or found it valuable, leave a like and subscribe. My next video will be talking about Uber stock and their earnings report, but it's not a stock I own, but I'll try to release it as soon as possible. And again, if you found this video valuable, leave a like and subscribe. Also comment down below what videos you'd like to see.